Okay, so the title of this, I keep forgetting to kind of update on my slides. It actually now does. Let me start with a couple of disclaimers. First of all, what you have in your packet, all the slides that I'm going to go through are in your packet, but I'm going to be going through them in a different order, okay? After I did this, so the first talk, the slides that Rory has printed off there, it's my fault. Those are from a talk I did last week, and the first of these lenders meetings was last week in Chillicothe. Those of you who've been around the state know that if you're going to present to people in Chillicothe, you've got to use smaller words and speak a lot more slowly. So now as I've gone to the rest of the state, I've kind of rearranged it for the more sophisticated members of the lending set. No, I kid. So the title, and I keep forgetting to update that as well, but it actually, this flows along with that title that you have there in your minutes. So it's a very interesting time in agriculture. This is not an Outlook talk. There are components of Outlook in it, but I think as a lender there are other things that Outlook, the logical conclusions of Outlook and Price Outlook have very specific implications for your business as we look out over the next 5 years. As Carl said, it's easy to look. I mean, let's be honest for a moment. The last 6 years, 7 years in row crop production have been the 6 most profitable probably years in the history of row crop production, certainly in this country. Realistically, it's sort of like hitting Powerball 3 times over the last 5 or 6 years. And the good news is that does mean there's been a lot of money introduced into the economy. The bad news is it is very easy, as an old saying warns against, it is very easy to confuse genius with a bull market. And I fear that we have more than a little bit of that right now in agriculture. And so if we're going to talk about what's going on in agriculture and where we're at, we need to talk a little bit about how we got here. And so I want to start with this slide. I know you've seen it. If you've heard me talk, you've seen me use it over the past couple years. Let me start by really complimenting you, Rory. That is a good looking projector. Those colors are bright. When you give as many talks as I do, even on Monday, I'm giving this talk in Urbana, and you can barely see the colors. It was like working with a grayscale projector, so my compliments. All right, so Chinese meat consumption. You've seen me probably talk about this. Let's go back to 1990. Does this have laser? Yeah. Go back to 1990. Chinese total meat consumption about 25 million metric tons. This year we're looking at something like 73 million metric tons. In 23 years, nearly a triple. Now the purple on top, that's birds. The red down at the bottom, that's beef and veal. The green is obviously the majority of this, and that's pork. That's where most of this growth has occurred. The growth, please don't misunderstand. Well, we've heard the numbers. So this is not all imports, although China is the world's largest importer of pork. They are also the world's largest hog producer. Over half the world's hogs are raised in China. And this is not a case of 3 billion people, each of them with 3 sows out back. This is a case that China has the world's largest hog operations. They are building more. They are expanding them. So this is not a case. They are not necessarily as efficient as ours. I believe that is the primary motivating factor for the purchase of Smithfield Farms this past summer. Is not for any of these supply procurement. I believe ultimately they are looking for management expertise, and they are looking for to improve their own efficiency. But they are expanding rapidly in their domestic production of hogs. You would be amazed, by the way, how fast you can expand animal agriculture when you can simply imprison environmental protesters. It radically changes the game. But if you're going to raise that many hogs, you must feed them. And so over this same time period, this is domestic oilseed consumption, 25 million metric tons to about 120 million metric tons. That's 9.8% growth per year for 23 years. 9.8% growth for 23 years. That is really astounding. It's one thing to hear something like that in a financial sense, where honestly we're talking about soft or ephemeral or tangible goods, but this is intangible commodity consumption, 9.8% per year. This light blue is soybean. That's the vast majority of that growth. We go back 10 million metric tons of consumption in 1990 to about 80 million metric tons of soybeans in 2013. So I mean, just hard to get your mind around that. And then it's not just beans, it's not just oil seeds, it is also grains. We see since 2006, domestic grain consumption has grown pretty rapidly, driven by corn, which is the orange. The blue right here is wheat. This is rice. You see some increase, especially the past few years, in wheat. Majority of this is in corn, and majority of this is driven, again, by feed demand. This is another case we'll get to a bit later. Chinese corn demand or grain demand is one of these areas that a lot of analysts and economists have been watching for years, saying to ourselves, at some point, China must start importing more grain than it does. What China has done quite clearly is they have made a choice in their agriculture and their row crop production to produce domestically those grains that are directly human consumed. Okay? So wheat, they import very little wheat, and the wheat they do is generally feed grade wheat. Instead, their domestic wheat production is focused on milling and bread. Same with soybeans. If you look at their domestic soybean production, their domestic soybean yields are very, very low, shockingly low, and they haven't been changing over the past 20 years. And that's because those are almost entirely food-grade soybeans. They are not feed-grade soybeans, so you're more constrained in the genetics and in the ability to grow those yields. But corn is one of these areas they still do produce a significant amount, but their surplus has been steadily declining over the past decade, and at some point that will also flip to a net import. However, economists have been saying this for years, that we're a few years away from China having to be a big importer of corn, and we're still a few years away. So we don't know when this will happen, but it is out there. Now, in going through this, so I would argue this is kind of the long-term setup, one of the two long-term setups for where we find ourselves. But I think it's hard to truly put this in perspective. We talk about million metric tons of grain, million metric tons of beef. I don't relate to that. I grew up speaking, as we all did, the imperial system, the traditional system of weights and measures. And even in there, a million bushels is difficult to relate to, but even more problematic, it's difficult to compare among crops. And so about 5-6 years ago, as I was thinking about this and how in some different contexts, it struck me, the way to really think about everything I've gone through here is in land. Okay? And the reality is, or the reason is, land is the ultimate currency of agriculture. In agriculture, or in economics, there's this principle that the owner of the scarcest resource accrues all the wealth. Okay, the owner of the scarcest resource accrues all the wealth. Why? Because they can play the owners of all the other resources against each other. Okay? In agriculture, I would argue in row crop agriculture, there are three scarce resources. Three scarce resources. What are they? Land, good job. Water. Okay, put it this way. Who's made the most money out of agriculture over the last 6 to 8 years when we've had this big run-up? Pardon? Genetics. Okay, I would argue now, in the Eastern Corn Belt, I don't think water is as much of a constraining factor. We know biologically it is, but I don't think it's really a scarce resource. It's rare that we hear people here worry about water from a production standpoint. We tend to worry not about the water, having enough water coming onto our crops. We tend to worry in this part of the country about having too much water running off of our fields and what we do about that. My friends in Nebraska would love to have that issue, or in eastern Colorado. Okay, here I would argue land is the number one scarce asset, genetics the number two, and patentable chemistry. Okay, chemicals that have patent protection on them is number three. And if you stop and you think about that, is where the profits have been made over the last 6 to 8 years. Okay, but so I put this in land in the context of land because it's also a great unit of measure and unit of comparison for agriculture. So let's talk about China for a moment. Let's talk about China. All those numbers we just spoke about, their soybean imports, what China has imported in the terms of soybeans. In 2001, which is the last year that neither United States or Brazil had a disappointing harvest, they imported 1.9 billion bushels of soybeans. It's roughly 45 million acres based upon U.S. and Brazilian, Argentine yields. Okay, roughly 45 million acres it takes to grow 1.9 billion bushels. A decade before, 2001, it took about 600 million, or they imported about 600 million bushels, or 15 million acres of soybeans. So over that decade, there needed to be another 30 million acres of soybeans produced just to meet China's import demand. 30 million acres. Now we can compare that. The number 2 source of row crop demand growth over that decade is U.S. ethanol. In 2000, right now, if we run the industry at full bore, it's about 5 billion bushels. The U.S. ethanol industry will consume about 5 billion bushels of corn. If we net out the DGS, that's about 3.4 billion bushels of net ethanol consumption, which requires roughly 22 million acres. In 2002, we produced about 500 million, or we used about 500 million bushels for ethanol, or about 2 million acres. That's 500 million bushels gross, or about 2 million acres. So over that decade, we needed about 20 million more acres of corn being produced to meet domestic ethanol demand growth. So it's 50 million acres. 50 million acres had to go into production to meet the number 1 and number 2 combined sources of demand growth from about 2001 to 2012. Now we can start talking about perspective. How many acres of row crops does Ohio produce? Anybody know? Roughly 8.5 million acres. So this is 5.5 Ohios to meet simply Chinese import demand and U.S. ethanol demand. Had to go net additional into production. Okay? Or 2 Illinoises, or however you pronounce it. Okay, I know people, 2 Illini, but I don't know if that applies to the state, but 2 entire Illinoises, all right, to meet that demand. They have about 23.5 million acres of row crop production. This is a lot of demand, and this is the number 1 and number 2 sources. We're not talking in here about Korean demand. We're not talking about Brazilian domestic demand, Chinese grain demand, Japanese, all these other sources of demand, Indonesian demand, Indian demand, aren't here. This is just number 1 and number 2 globally. Tremendous amount of demand growth over the last decade. Okay, tremendous amount of growth. And now, as we say, you've heard the old saying, the best cure for high prices is high prices, and we see that as well. So in the last decade, we've had global soybean production increase by 90 million metric tons. That's about 3.3 billion bushels. That is roughly, okay, actually no, that'll be a little more than U.S. annual production, 1 year's production of the entire country, United States. Likewise, we've seen global corn production increase by 11 billion bushels. That's about 80% of a year's production in the United States. And we've seen global wheat production increase by 4.3 billion bushels over that decade, which is, again, roughly 1 United States. So at the same time we've seen that amount of demand growth, we have seen supply growth just of now. This supply growth, this is not only new land going into production, this is also actually yield growth is included here as well. But we've seen global production increase by an additional United States over that time. Now, quick economics. Here's your economics quiz. Which has grown faster, demand or supply, over this last 10 years? I assure you I can withstand an awkward pause longer than anybody in this room because I teach this stuff, I can't say every day, 2 days a week. Demand. Why do you say that? Excellent. Somebody was paying attention. Okay? What were our prices like? What was the price of soybeans in 2001? Average annual price in 2001 was $4.35 per bushel for soybeans, not corn, soybeans. Right? Corn, I think it was about $1.92, $1.93 was the USDA average annual price. So even with all this growth, we're now talking about soybeans twice as high, 2.5, 3 times higher than they were. Corn, 2.5, 3 times higher price than it was, even with all this growth. Demand has outstripped supply over the last decade by a long shot. Okay? So not only are we seeing there's massive increases in consumption, we're seeing massive increases in consumption at massively higher prices. All right? And that's, so this last decade has just been incredible. And when you put it in a global context, in a historical context, there's been no time in human history that we have had as few people on earth in percentage terms that are starving or food insecure as we do right now. There's never been a smaller proportion of the world's population that is starving than right now in human history. Okay? And we're seeing it. That prosperity is reflected in our row crop production. And that prosperity is reflected in the profits that we've seen in agriculture, in row crop agriculture, over the last 6-7 years. The problem is, as we talk about all of this, the number 1 and number 2 sources, number 1 being China, number 2 being ethanol, that number 2 source is done growing. Best case scenario, ethanol stays where it is. That's the best case scenario. In fact, it every day gains some more opposition in Congress, and we may see in 2 or 3 years corn going to ethanol may actually decline. Okay, so the salad days of this unrestrained growth in demand are over. And it's not just been unrestrained demand that's given us the prices that we've had and that we've enjoyed. It's also been, as I'll get to in a second, the last 4 years have been a time we've had 8 years of massive increases in demand, and then we've had 4 years of relatively poor production in the United States. But now we see demand slowing down, and then the question comes, how long is it until we have a normal crop year? Well, how often do normal crop years happen? Relatively often. That's why we call them normal, right? Okay? That's why we call them normal. And so when we talk, I'm going to focus much more on that number 2 source of demand, and I'll talk a little more about why. But U.S. motor fuel usage peaked in 2007. Okay? You can look since 1990, just every year we were using more and more. This doesn't include diesel. This is just gasoline. More and more and more and more. And yeah, okay, it slowed down a little bit, 05, 06. But this trend looked, if we went back to here to 06, we thought that by 2013 we would be consuming about 165 million or billion gallons in 2013. Okay? Instead, we're on track to consume about 133 billion gallons. Significantly lower, 10 billion gallons lower than we were 6 years ago. And there's a lot of factors that are contributing to this. Not only higher fuel economy in vehicles, and it's amazing how much the fuel economy of the U.S. Automobile fleet has increased in the last 6 years since the recession, but also we're driving less. This is total vehicle miles driven, okay? And I don't believe this is over-the-road trucking. I got to ask that, and I need to go back and look. I think this is more passenger vehicle miles, but I'm not certain of that. If this includes over-the-road trucking, it's even more problematic. It peaked in 07, it declined, but it has not really recovered. Okay, we're still below where we were even in 09, certainly in 08. So the recession really reduced miles being driven in the United States, and it hasn't recovered. Okay, and the net result of that is a lot less gasoline being used when you combine that and fuel. And there's a lot of, it's really cool stuff. You know I'm a car guy. You know that's where I grew up. So I could talk the rest of our time just about all of the changes leading to this, but I won't. Okay. So what does this mean? Well, so when this bill was written, the 2007, it was passed in 2007, Energy Independence Security Act of 07. When it was written was more like, again, 06. In 06, we thought this was just continuing. We'd be using more and more gasoline every year. So when it was written, and we saw that down here, in 2013, we'd need to consume 16.5 billion gallons of renewable fuel, of which 13.8 billion gallons is from corn ethanol. We said that's fine, okay, especially us in agriculture. We said 13.8 billion gallons, 16 total. Well, there's no way we hit this cellulosic ethanol. That's just total fantasy. Once we waive that, which we have, that's this red number. It's never been this hot. I mean, it's always been waived because we just can't produce it for any reasonable price. We knew this had come down, and we said, all right, so this ends up, this total mandate in 2013 is maybe 16 billion gallons. Maybe it goes to 17 billion gallons in 2014. That's fine. By then, we'll start to feel the blend wall a little bit, but we're in good shape. No problems. The problem, but now when we're talking about a market of 138 billion gallons instead of a market of 165 billion gallons, we have big problems. And the big problem is there's not enough. If we blend every gallon in the United States with E10, that is only about 13.5 billion gallons. The E85 market is not that big. Okay, it's a few hundred million gallons per year. Simply not that big. And so it has created a huge amount of stress in the industry. And where we see it is in, and I've got to go out and find an updated chart. These prices, unless you subscribe to one or two services, are very expensive to get, and so I don't have them. If somebody would like to write me a check for $5,000 a year, I'll subscribe to them and have a better updated, more often updated chart. But until then, just saying. So what these are called renewable identification numbers, and we'll look at this D6, the red line down here at the bottom. D6. So when Congress created this law, it was obvious that there would be differences in the price or in the ability of blenders to blend ethanol. How this law works is basically November, December of each year. The EPA will tell every blender in the country that they will need to blend, say, 11%. In 2014, the number will probably be 11 point some fraction of a percent. So of all their gallons, 11.2%, 11.3% have to be ethanol. Well, Congress recognized that this would create problems, and there are big disparities in the ability to blend ethanol. It was always going to be a lot cheaper for somebody in South Dakota to blend ethanol than somebody in Maine. So they created a mechanism where a blender in Maine can basically can blend 1 gallon fewer and pay a blender in South Dakota to blend 1 gallon more of ethanol. And this is these RIN, or Renewable Identification Number. The idea being in South Dakota, that's where it's made, it's cheap, you got lots of E85 flex fuel pickups that can burn E85, and so it just shifts it to where that gallon gets consumed at the least cost possible. Okay? To where it's, and so as an economist, this is great, it's a wise mechanism. But what happened as we go into last summer, we see prices take off as the drought takes hold, but also as the blend wall becomes more binding. We got up over $1. We're now down at about 40 cents. I was just reading yesterday, 40 to 50 cents. So it's come back down. But what does that mean? Even now, even in the midst of harvest, corn's very plentiful. There's no shortage anywhere. Somebody is willing to pay somebody else an extra 40 cents to get out of their legal obligation to blend ethanol. Okay? So that's the idea. And so it's a measure, it's a very vivid measure of how binding this blend wall is. And it's becoming more binding. And especially after we have these spikes up to $1.25, it has increased pressure on Congress to reopen these mandates in the energy in ISA in 2007. There have been rumors floating around the markets this week. I think that they are premature. But there have been rumors floating around the market that, in fact, the EPA would reduce this number, this 14.4 billion gallon mandate for 2014 down towards 13 billion gallons. I don't believe that's going to happen. I think that there will be reductions in the mandate. I expect that we will certainly see a reduction in the cellulosic biofuel mandate, something closer to 25 million gallons from 1.75 billion. We'll see a similar reduction in this advanced biofuel. But I don't think we're yet to the point where they will reduce corn. If so, that will be bloody. I will say it now. But I don't think that will happen. It could happen in 2015, but I think where it really The real issue is going to be what happens over here. I think this is in good shape, but again, the more binding that blend wall becomes, the harder it is to blend, and the more motivation there is on the part of opponents to this law to lobby for its repeal. Okay? And so ethanol usage, after seeing, again, this, when you look at what we said here, 600 million bushels going into ethanol in 2000 to 5 billion bushels in 2010. Just tremendous growth in that industry. And now, best case scenario, we're flatlined at 5 billion bushels. Best case. So one of those two big drivers, the number two driver for demand over the last decade, is gone. Okay? That demand growth is gone. We keep the 5 billion, but it's not going above that. And that's what has really driven things. All right? So the question becomes, where does that corn go? Does it go to cattle? Well, cattle inventory since 2007, since prices went up starting in 06, 07, cattle inventory has dropped. Now, I know it's very popular to blame the high grain prices for the drop in cattle numbers, but I think there's probably a trend that was already in play here. Okay? We're seeing this rebound with the very high cow and calf prices that we've got right now. We are going to see that rebound, but there's no way it's going to pick up the slack. If for no other reason, after strong profitability enters into the cattle markets, it takes a good 3 years to see a turnaround in cattle numbers or significant increase in cattle numbers in the United States because of the life cycle of the animals involved. Okay? So it's not, as ethanol is flattened out, we can't expect cattle to pick it up. Hogs, we have actually seen growth in the number of hogs in U.S. inventory over the past 3 years. If we throw Canadian inventory in here, actually I think it's actually grown a bit faster, but it takes about 18 months to see that continue to grow, or see those numbers grow. So this will take up, hogs will continue to take a little bit more and more, but we're talking about 1 million head of hogs, 2 million heads of hogs. That's not going to offset the lack of growth in the ethanol industry. Okay? So hogs, again, 18 months to really accelerate and make changes in that. We're already in an upward trend there. It's not a fast trend. Okay? It takes more time to ramp that up. Bird numbers, we are seeing birds are in profit. Poultry is. Poultry, it tends to take them about 45 seconds to turn their market around, both to increase numbers and then later to overproduce. That's kind of the way the poultry industry is. So we don't see this big trend of explosive growth in feed. Okay, yeah, we're seeing a rebound. This year we're going to use a lot more feed. We're going to feed more corn and DGS. But guess why? Because prices are lower. I mean, last year, who didn't get tired of listening to all those stupid "we're feeding Halloween candies to our cows" stories last year, right? That was all we read for a while. But it was low prices because of high prices, because of the short crop, lower prices. We're seeing a rebound, but it's not going to offset ethanol. Same with exports. We'll see those continue to increase, okay? But even if we saw them go back to our peak from where we're at now, that's only 2 years of growth of ethanol. If we go from now to our record export level, it's only 2 years of the long-term growth in ethanol demand that we had over the last decade. So there's no savior here. And the real issue, like I said, especially in ethanol, it really had flattened off as of 2010. We should have seen steadily lower prices since 2010. But we didn't. We didn't because we have not had normal yields, trendline or above yields, for 4 consecutive years. I can't find a place in the data at the national level that this has happened since 1900. Okay? Now, what does that mean for next year? I have no idea. But at some point, we're going to have normal yields. And let's think about the year 2013 from a growing perspective. This was a pretty bad year. And yet we're still talking about 158 to 160 yields. If we'd had a decent April, I think we'd be talking about 168 yields. Okay? It's a matter of time till we're talking about 175, having a year with 175 national average yield. It could easily be 2014. It's not that far out. When we look at the distribution, 175 is not a crazy number. 171 certainly not a crazy number. Okay? And it's going to happen, and when it does, that's a lot of corn with no markets to consume it. A lot of corn, no markets to consume it. Okay? So I'm going to skip those. Soybean yields, kind of a similar story. 1, 2, 3, 4 years. 4 years ago, we've had 3 years kind of crappy yields. Okay, 4 years ago wasn't awful in 2010, but certainly since then. So it's very similar story there, although the demand on the soybean side has not slowed. When we look at Chinese import demand, it has not slowed. In fact, as an analyst, trying to keep track or forecast Chinese soybean imports is infuriating. I've given my hands up, and I simply assume they will import as much as the rest of the world grows. And that's the pattern we've seen for the last 12 years, 13 years. They will consume a tremendous amount. Let's see, I'm going to, again, skip all this stuff, except to say story similar. Not quite the same. U.S. total production and use has continued to increase. I'll do this as well. Here's global production and use for soybeans. Look at that. I mean, we see it steepen a little bit in the mid-90s and just continue to grow. When I started at Ohio State in 2001, we were at about 173 million metric tons of soybeans being grown a year, produced a year. And all we heard about when I went to strategic planning meetings for the soybean industry was whether we would still have an industry by 2011 or 2012. Because all everybody heard about was Brazil had 200 million more acres of soybeans waiting to go into production. And we were going to lose our domestic industry. And yet again, as we talked about, here we are today. 12 years later, we're at 282 total production, 269 use. Prices 2.5, 3 times higher. Amazing amount of demand. So I think that number one source of demand stays in place. That soybean demand is still there, still growing. It's not just China, it's global. We talk a lot about China and their meal demand for raising animals. An interesting statistic, the Food and Agricultural Organization of the United Nations. If you want a good index of the wealth, the growing wealth of the abjectly poor countries, the Burundis of the world, a great measure, especially of how well the poorest there is doing, is what is happening to their vegetable oil consumption. Because just like as you go from about $2,000 up to $5,000 per head in income, you start adding meat to your diet with more frequency. As you go from 0 to 2,000, you start adding vegetable oil to your diet because suddenly you're now having a little extra. Vegetable oil provides that, again, the proteins, the nutrients. It allows you to make some bread and do some other very basic food processing. And so it's not just China eating more pigs. It's also many other countries bringing more oil into their diet as well that are lower on the income scale. So I think this story stays intact. Global soybean production and use is there, but it's not clear that it's going to be able to absorb all the acres that are about to get a way less valuable growing corn. Not to mention all the acres that have come in around the world in the last decade. I was at University of Tennessee. Martin hosts a bankers or a lenders school every year in August, a young lenders school, and then they do a big lenders seminar. There were about 300 in their one-day seminar. I spoke. Did I talk about it? I don't remember what I talked about. Something there, but Richard Brock did the crop outlook. So I was talking to Richard Brock beforehand. He had just booked a gentleman from. He's an Iowa farmer. He lives in the Ukraine. He manages a farm in the Ukraine. He's a farm manager there. His farm is 125,000 hectares. Not acres, hectares. For those who don't speak metric, they're roughly 2.5 acres per hectare. Okay? Most of that land has gone into production in the last 12 years. It was in production 20, 25 years ago in Soviet times, but it laid fallow. Okay? Because let me tell you, the Ukrainian government, the U.S. government, when it's shut down, is 10 times more effective than most governments when they're operating. Okay? 20 times. One might make the argument it's still about 3 times more effective than the U.S. government when it's operating, but that's a different story. But when you have $6 corn, or more appropriately, $10 wheat, That creates a lot of profits that are out there to suddenly pay off a lot of petty officials that get in your way normally. To build storage infrastructure, to build rail, to build ports, and that's what's happened around the world. A lot of productions come in. I think bean demand is there to absorb it, some of it. But corn, there isn't that growth out there. And so land, was Barry here earlier or not? Talk about land value. Okay. I'm not going to go a lot through land value. What's driving land value? Honestly, at the end of the day, there's two things driving land value. Net income. I mean, again, last 6 years have been phenomenal in crop net income. Phenomenal numbers. Huge amounts of money have been made. Well, what's happened? Stronger debt to asset ratios. We've gone from 14.1, this is USDA numbers, in 02 down to 10.2. We look at the grain sector alone, the change has been much bigger than that. Okay, the grain sector debt to asset ratio has improved even more, and that means a lot more dollars to invest. Okay, that high income has brought a lot of outside investors in, and we've had very low interest rates. That's what's driving land prices. It's very simple. Lots of profitability, low interest rates, lots of excess cash flowing around. Okay? The issue is, what's the outlook? Interest rates have already begun to rise. We know that. On the long end, 75 to 100 basis points over the last 12 months, depending which day you pick as your start and finish. Ethanol expansion has stopped. That's going to pressure that profitability, because that profitability right now over the last few years looks really good because we've had 4 short crops, and we've had, because of that and because of the tight markets, we've had very high insurance guarantees. So we've still had very strong profits over these past 4 years. Okay? Yet our expansion has stopped. Okay? We still have those strong balance sheets. And I think the net of this is that we're going to see those prices stagnate and weaken. We'll see them stagnate for a year or two. I believe we're already starting to see that. And then we're going to start seeing farmland prices turn around. Dave Cole, he and I are kind of on the Lenders Chicken Dinner circuit around the country. We end up on a lot of the same programs. He advises that lenders should do a stress test of what happens if land values decline by 35%. He believes 35% is a good rule of thumb. I think that's too pessimistic for an actual kind of baseline. I don't think it's necessarily unrealistic if you just want to scare the pants off your risk people, your risk managers. But it's, it's something to think about. That's where he's at. If you were listening today to Mike Bolge from Purdue, or Chris Hurt, or Corinne Alexander, although Mike is the one who does this part of it. I heard Mike at, I don't know, one of these talks again. I think he was at the Nebraska bankers meeting in early September when I heard him talk. Purdue right now, no, I'm sorry, it was an Outlook thing in August. Purdue's party line right now is actually pretty negative. I mean, they're not quite calling for the 80s all over again, but it's not far short of that. Okay? And here's the story that Purdue tells. Low profits, 5-6 years. Weak demand, significantly weaker demand. We continue to see trend line growth in yields, especially in corn yield, moving up high 160s into the low 170s. We see ethanol flat. We see China continue to expand, but in their soybean, but a lot of international competition for that, a lot more acres coming in. So moving to a normal price of corn, a more normal price on the board of $350-ish, okay? Farmland average prices of maybe $325 to $370 over the coming 5-6 years. So lower and lower prices, lower and lower profitability. Because of that starts to go below many cash needs, many cash costs of production. So what you have the first year, you're insulated from that because of the insurance program. But year 2, your insurance guarantee is based upon market prices at planting. So it offers no protection from these low levels of prices and income. So by year 2, you've now exhausted all that prepay that these guys now have. You're going to use that up in the first year, use your insurance guarantee up. By year 2, your revenue is actually lower than your cash cost of production. Okay? So at that point, you're now drawing down working capital. Maybe that lasts for a year, but probably even within that first year, people will exhaust their working capital reserves. By year 2, people are now some growers are having to draw out of their equity. Meanwhile, nobody wants to put land on the market because the cash is drying up, the profitability is dried up. Any land that has to come to market, say because of estate issues, it comes into a pretty tepid market, and so that lowers land valuations, right? Lowers land valuations. There's less money out there. By the time we hit year 3 and year 4, more and more people are having to draw out of equity. Some people are being forced to liquidate land because the equity has fallen far enough, or prices have fallen far enough to wipe out some of the equity on some of their land. And so now we're getting into forced liquidation of land. And at that point, it becomes a self-reinforcing spiral. Okay? That's the story that Purdue is telling right now. I'm not that pessimistic. Okay? I don't think that is impossible. I think I would much rather start with that story and scare people with it and say I'm not that pessimistic. Here's why. I think that we will see 5 years of low profitability. I think that we will relatively quickly will find some adjustments in the market. Okay, some acreage adjustments, land coming out of corn, shifting back into hay. I think we'll see some acres go into pasture that have come into actual row crop production in the United States. I think we will see that shift, but it's a 2, 3, 4 year process. Those 2, 3, 4 years are going to be very, very painful. And you will see you will see farms fail in this 2, 3, 4 year adjustment cycle. Okay, that was not a Freudian slip, I swear. You will see farms fail. But as people who spend a lot more time looking through FinPac data tell me, and so I'll trust them because this is not my area of expertise, who that's going to be driven by, I don't believe. So Purdue's story on some level is really built upon the idea that we're in a farmland bubble. And I honestly don't think we're in a farmland bubble. I think farmland prices are high, but I don't think they're necessarily unjustifiably so. But I think we're in a cash rent bubble. I think we're very much in a cash rent bubble. And that's going to pop. And that's where you're going to see farm failures. In most areas, one of the things I always like to ask is I want you to think about your bank, where it's located. And I want you to imagine a family. There's a family I'm thinking of that 10 years ago, 15 years ago, they had about 1,000 acres. Now they run about 12,000. They still only own about 1,000. Maybe they own 1,200, 1,500 acres now. Almost all the rest is cash rented, most of it in long-term leases. They're rolling all their equipment over every 1 to 2 years. Do you guys know the family I'm talking of? Out of curiosity? I don't. I'm not from this area. Okay? Most areas have somebody like that. Okay? I don't know if in Northeast Ohio that is quite as common. Certainly by the time you get over towards Bellevue, I'm guessing you can think of some of those, Valerie? Okay? That broadly fit that, if not those exact numbers. Am I right on that? I mean, not that are customers of yours. Not at all. I mean, I'm sure none of you would have a customer like that because you are the good and the wise and the great. But there have been a lot of operations that have expanded very aggressively through cash rent on 2, 3, 4 year contracts. Okay? Through very aggressive cash rent bids on 2, 3, 4. They're very aggressive in rolling machinery. Those are the operations that are most vulnerable. As I said, I'm sure none of you lend to them. So you don't need to worry about that. Except that do you lend or finance people who do give them credit or do business with them? Anybody drive by an equipment dealership today on the way here? Nobody? Maybe drive by one in the last day or two? Okay, any of you, okay, I was going to say, any of you who are managers, you need to look around, because if anybody's saying, no, I haven't driven by one in the last 3 days, those people need fired. Just say it, right? Unless it's you, in which case, take a hint. What do they look like? What do the equipment dealership lots look like? Pardon? They're full. We haven't seen that for 6 years. Okay? And they're full with used equipment. A lot of equipment on those roll programs. Okay, those rolling programs were at the manufacturer option. Those were not at the farmer option. Those were manufacturer option. Okay, well, the farmers also had an option, but they could only exercise theirs if Deere or IH offered the role. They've stopped offering those roles because where they've moved that used equipment over the last 6 years, South America, Ukraine, the rest of the world has really pretty equipment right now, really nice, like lightly used equipment, and they're full. Farmers here that are conservative, who waited and are happy to run equipment 6 years old, they all have equipment that they've upgraded as well. That used market is full. And in case you don't know, those, I mean, I assume all of you guys know this, that used equipment is not financed by Deere or IH. Okay, that's not vendor finance, that's lender financed. Is financing that. And I think that market is going to be problematic. All the other suppliers to these farmers, whether chemical suppliers, chemical dealers, okay, seed dealers, all these others, do you have exposure to them? That's what you need to be asking yourself. I don't see a widespread number of farm bankruptcies, but I do think we will see some very large farms go bankrupt in the next 5 years. And even if you're not financing those, think of the consolidation we've seen in equipment dealerships in the last decade. Think of the consolidation we've seen in chemical dealerships the last decade. Okay? You may have zero exposure to the large, aggressively expanding farmers and farms, but you almost certainly have exposure to firms. That's really awkward. And I even had it in there upside down so I couldn't just hit the button. I used to, the first day of class, I used to go into this big spiel about, put your phone on vibrate, that's so rude, blah, blah, blah. About the 4th year I was doing it, my phone went off as I'm in the middle of that talk. And I said, you know what, you're all adults. So, my apologies. Even if you don't lend or do business with those really aggressive farms, you almost certainly lend and do business with those who do business with them and finance them. That's what you need to be thinking about. The web of interconnections in the agricultural economy right now has gotten a lot smaller in the last decade. Okay? And I think, and the reason, okay, going back to those rented farmers, we have these very high cash rents. Those are not sustainable. The prices that we have right now make those not sustainable. 9 months ago when I was here, 10 months ago, 9 months ago when I was here for the Outlook meeting, so we're not that far away. We're one good harvest away from having $3 on the front of our corn prices. We had kind of a lousy harvest, and yet last Tuesday, when I was, not this last Tuesday, I'm sorry, today, Wednesday. Yeah, last Tuesday, not yesterday, but a week ago yesterday, Plain City Heritage at Plain City was bidding $3.95 cash. And we didn't even have a great harvest. Okay, so even at these prices, we're below the cash cost for a lot of these aggressive farms, even here. Okay, and I think the only way that those rental contracts get lowered is through default. I don't believe a farmer, one of these aggressive farmers, going up to their landlord and saying, it's been bad these past few years, or it's been bad this year, price is low. They signed a cash contract. And I think there's a lot of landlords out there that are still a little bitter about 2006, 2007, 2008. And they're very high prices, very high profitability. They didn't have farmers just lining up to say, hey, it's a great year. Here's an extra $75 an acre. Maybe a few of them got $10 an acre. Okay, but I think there's still a lot of bitterness there. So I think ultimately default's going to be the only way we see that rationalization in the rental market. That's why I think that's where the real dangers are in lending. Okay? So insurance, that's a one-year deal. It's like Carl said. I mean, first year of these low prices, insurance gets us through. That's fine. What about year 2? It's very different. Acre, something like Acre would have been great. It'll almost certainly go away because it was built just for the scenario we're coming into, which is 3, 4, 5 years of low prices. It was built to ease, to make that a more gradual slide into low prices. And that's almost certainly going away. But in the long term, only the balance sheet keeps a farm in business or any business operating. Okay? So when I talk to growers, $4 corn, it's a matter of when, not if. Well, we're here. The win is now. $9 beans, we haven't quite hit an $8.99 print. But what I've been saying for the last 4 years, telling growers, we're in salad days. We're making a lot of money. What do you need to be doing? The first and foremost is build working capital. Because at the end of the day, so I like to think of the balance sheet as the heart of the business. Farm programs, marketing, those are just layers of armor, insurance around that heart. After those are peeled away, the first thing that gets exposed is working capital. So they have to be building working capital. I've been saying it for a while. And I'll be honest, nobody likes carrying cash. In any business, even personally, this isn't a farmer thing. I don't carry cash, okay? Because when I do carry cash, it goes into a vending machine, okay? That's just the truth. When farmers carry cash, it goes into that 40-acre field that they've been eyeing for a long time that just came up. I get it, okay? But they need to realize this is potentially a life or death kind of situation for their farm. And they also need to realize that by building capital as soon, and maybe this window's passed, for those that it hasn't, having that cash, I mean, let's face it, every farm we know is over-machined, has more machinery than capacity. If we see default on these rental agreements, the way I think we will, there's going to be some acres out there available for rent with some very motivated landlords in the next 4 or 5 years. If you've got the working capital, you can take advantage of that, because then you're going to be able to take advantage of operating lines. You're going to be able to take advantage of all the things that happen in a normal year. So working capital is huge. I'd like to see growers have 1 year's land payment, whatever their land charges are, rent plus land payments. I'd like to see them have that above and beyond their normal working capital needs. Normal working capital in cash, another year's payment in cash, or year's charge in cash or near cash. Okay, that doesn't make them guarantee they survive a Purdue scenario, but they'll survive my scenario on that. And I'm just assuming if you go into it with that, okay, there's going to be enough other people who don't have that, that production's going to rationalize before you hit the bottom, before you run out. Okay, it may get bloody, but you'll be the last man standing, and that's always the goal. People don't like carrying that, I get it, but I think it's important. And the key thing is that it is in cash or near cash. Typically growers, this is one of the points I like to make, growers like to point out, well, I can write a check for that. I mean, I've got my line, I've got my, all this equity in my land. I like to ask them, listen, all right, so you've got this land, let's just say it's $10,000 an acre, and you owe $6,000 on that land. You got $4,000 in equity. If the value of your land goes down by 25%, is the bank going to split that with you? Okay? No. It comes out of your equity first, right? So it doesn't take long, it doesn't take much of a land price decline before their equity gets wiped out. And that's the key point they have to remember. Okay? So equity is not a substitute for working capital. The other thing, observations that have been shared with me. Look around. This audience is not as typical, but you still see signs of this. If you look around in any ag lender meeting, what you tend to see is a lot of people who are 55 or older and a lot who are 35 and younger. There's kind of a hole in the donut, so to speak, or 40 and younger. Okay, and really probably a little closer to 35. This audience is a little different. I do see some donut holes here. Okay, you've got a little bit of filling. All right? But it's true. And so what's interesting is there's a lot of knowledge that the older lenders have accumulated that the youngers haven't. And that's fine. None of this is a statement. But one of the things in sitting and having lunch that I thought was very fascinating, 2 fascinating observations. The first is, and I've seen this, you guys have seen this. There's been a lot, so the part of the income statement that has grown the fastest is family living. I mean, if you look at family living expenses writ large, whether salary or family living that's carried directly on the income statement, family living, not expenses, let's just put it this way, family income from farming operations has exploded. It's the fastest growing. It's outstripped any other input cost over the past 10 years. Okay? Go out in Iowa right now, the hot thing to have is the second vacation home. I mean, everybody already has a lake home. Now it's a mountain home or beach home. Okay? Out in, there was one guy, Dave Cole was telling me he knows, he tried to excel Section 179 and